So welcome everyone. This is a pretty informative, I think, session that I've been looking forward to with Peter here. The first thing I'll do is the housekeeping. So first of all, questions and answers. Peter's got the answers, maybe, hopefully, and people have questions. So Peter really wanted to make sure that people had questions for the session today. So please feel free to send them in. There's going to be a Q&A session at the end so that we could actually go back and forth and really do that fireside chat kind of conversation. Mia's is on the call as well on the Zenbooks team. She's going to help make sure that we're addressing any questions that do come up. There is a Q&A functionality, as you may know, in Zoom. There's also the chat in there. This whole session is recorded, so you could watch this whole thing later on if you've missed a few parts and you wanted to rewatch certain aspects, or if you wanted to forward the whole session to a fellow business owner. It makes a lot of sense. So, first we decided that we wanted to host this session because we're worried. I've been worried about the Canadian economy and what the economy has in stores for the next few months and years. We're an accounting firm, and we often advise clients on the historical kind of side of things, but also on some of the future whenever we can, right? And so I'm not an economist. I don't think there's many other economists on the call today other than Peter. And so, I think it's important for us to get information from the sources that know best. And basically, getting Peter on the call today is one of those things. And so basically I think that it's important for us to have, truthful information from Peter himself. And so today we have Peter Hall. Peter Hall is was the chief economist at Export Development Canada. Now he leads a boutique business strategy advisory firm, and basically advises a lot of business owners on countries' risk analysts, comprehensive forecasting for internal and external business strategy purposes. Mr. Hall regularly comments on global and Canadian economies on print media, radio, television, and has authored EDC's widely circulated weekly commentary. So prior to EDC, Mr. Hall directed the economic forecasting activities of the Conference Board of Canada and has served as the president of the Canadian Association of Business Economics. So that's like a 600 plus member organization of professional economists, and they have a large chapter in Ottawa. And so the Ottawa Economic Association. And so he currently serves on the board of directors of 2 Ottawa charities as well. So we're very lucky to have Peter here today.
A multiplicity of advice before actually going forward, and in no way am I liable for anything that occurs along those lines. My lawyer just told me to say that, and I know it puts a damper on the presentation right from the beginning, but I stand by everything that I say, and I actually publish quite a bit of what I say, and forgive me for the wind here, it's destroying my wonderful hair. I'm going to share my screen with you and walk through some things with you that I believe are fundamentally important to understanding the outlook at the moment. And that is really why Eric asked me to be a part of this. I had made another presentation that he had sat in on, and I hope you don't mind me saying that, Eric,
yeah,
and was excited about that. Some of the observations that are there. Some of the observations that I will make today are observations that you might not read in popular media. And you may not find a lot of economists actually saying this. So that's why Eric said, I am more than welcoming questions of any kind that you might have. In no way am I going to cover everything that's going on in the economy right now, but I want to hit on some real essentials to the way that I'm actually looking at things, and what has actually guided me in my forecasting career for some 34 years. And enabled us to actually accurately track not just the deep dark past of my forecasting career, but right up until the time when I left EDC. And of course, I'm still using those techniques to advise companies now, and that all seems to be going quite well at the moment. And so those who are talking with me about things and getting my advice on things are very happy with what it is that they're hearing, and they're taking action based on the things that I'm saying. And I'm perfectly comfortable with all of that. The disclaimer is just about direct liability to that. But I stand, as I said, by everything that I say. So how are we to make sense of what is going on right now? This is a very, very chaotic world. And many people that are in my profession are actually out there saying things and writing books along the lines of, it's just not possible to properly forecast things that are going on at the moment. The models are broken. You'll hear phrases like that. Very good friend of mine, former Bank of Canada Governor Stephen Poloz, has written a book called The Next Age of Uncertainty. And that's a play on a phrase that was coined by John Kenneth Galbraith and had a lot to do with Stephen Poloz's time as an economist forecasting things. And these are some of the observations that he has. You can walk away from that with the conclusion that, why is it important to forecast? Well, the interesting thing is, whether we like it or not, we're all called on to forecast. We all have to take a position on what is going to happen in the near-term future. So the professional forecasters, the ones that spend every waking hour sort of thinking about what the outlook is going to be like, if they are saying that forecasting has become a less useful exercise and a less possible exercise because of the phenomena that keep hitting us, mostly black swan events, which are happening with stunning regularity and disarming regularity at the moment. If that's the case, and we can't forecast, well, what are we supposed to do about this obligation that we have to forecast? Surely the professional forecasters can tell something about all of this, like give us some light on this. Well, I don't believe for a minute that it's impossible to forecast right now. As a professional forecaster, I was always called on to do that, whether it rained or whether it was snowing or whether the sun was shining. And I mean that metaphorically. I was required to do this. And I believed it was my obligation to take a position. Whether I ended up being wrong or not, I needed to take a view, saying, well, it might be this or it might be that, or being the multi-handed economist, as George Bernard Shaw was very famous for saying, yeah, I've met many multi-handed economists. They don't want to take a position on something. Here are the options. You decide. It's like, if the professional economist is not going to be gutsy enough to actually take a position, how could somebody who's not a professional forecaster do the same thing? How could you possibly require them to do that? Well, our business masters, if that happens to be ourselves as business owners, or those who are employing us, require us to take some kind of view with the millions of dollars that we're actually putting on the table and saying, okay, this is what we're going to do. And of course, we collectively make those decisions, but we are under obligation to those forecasts. Okay, so big question then is, can we make sense of what is actually going on out here? And that has everything to do with war and the geopolitical situation. It has everything to do with the onset of inflation and the rapidly rising interest rates that we face right now. And of course, all of the projections that we have about the economy falling into recession. So what are we going to make of all of this? Well, I believe that if we don't know where we've come from, and if we don't know where we are right now, don't even start to forecast. That's the premise that I always gave to my staff. So when you come to the table, whether you're forecasting copper or oil, or whether you're forecasting interest rates or the economy of Azerbaijan, which, we actually did 160 plus economies around the world, you need to know where that economy has come from, and you need to know where it is right now, because those are your two biggest clues as to where you're jumping off into a forecast. And so the same is true for the world economy. We need to know those things. Well, if we look outside of our window right now, we might look at things and say, well, everybody's very much in sync right now. All the central banks are raising interest rates, and every economy that we can see seems to be dealing with inflation. They're all carbon copies of each other. So what's going on is actually a global phenomenon. And I want to challenge that thought right from the get-go here. So let's start off this presentation with a tale of two economies. Let's look at Canada and the US. There are no two economies in the world that are more homogeneous than the Canadian and US economy. So when people are looking at cross-border economic phenomenon and they want to analyze small differences in an economy, their assumption needs to be, okay, these need to be pretty similar economies, and then we can look at the distinctives. Well, they always come to Canada and the US. Same language, roughly the same culture, same historical background, that's for sure, and a lot of the same tastes and preferences in terms of consumer products and in terms of the way businesses invest and so forth. And so we're very much like each other. We do have distinctives. We're a resource-based economy. They're a much more multifaceted economy than we are. However, having said that, we are a much more multifaceted economy than most small open economies. That's a category that Canada falls into. Anyway, whatever. A lot of economic mumbo jumbo there. When we look at these two economies, there should be no two economies that are more in sync with each other. So let's ask ourselves that question. Are they? Well, let's look at consumer price indices first. Now, here's a metric that I came up with to try and figure out, okay, is our year-over-year rate of growth in CPI actually going to go down or going to go up? So I invented this orange line here, which wasn't very hard to do. It's the 4-month moving average of the annualized monthly growth in core CPI for the United States. And if the orange line goes above the purple line, you know that the purple line is going to rise. And you can actually see this. When it took a jump, purple line rose. When it actually fell below the purple line briefly at the end of 2021, it foreshadowed the decline in annual CPI that we actually see right now. But what's disturbing about this is that the number is actually, the orange line is actually above the purple line. So regardless of the way in which the Fed is actually raising interest rates right now, this indicator is saying that this is going to continue going up. Well, that's not making anybody very happy right now because prices are high enough at the moment. And so this is a bit disturbing. How about Canada? What's Canada's situation here? Well, you can see that the year over year in Canada is rising quite remarkably. And this is right up until current history. It says May on the bottom there, but that's just because of the way the bottom scale is. It's right through to June. The July number is going to be in very soon. Where are we at with respect to core CPI? Well, we're much worse off than the United States, but the trend is actually the same. This is actually indicating that in spite of the aggressive stuff that the Bank of Canada is doing, you can expect to see this number go up, the year-over-year number go up, unless there is a massive change to core prices very, very soon. Like if, the monthlies start going down radically, well, of course, the 4-month moving average starts to move pretty quickly. As you can see, this can be quite volatile, the orange line, that is. And so once this goes below the purple line, that's when we're going to start to see some progress happen on this. Okay, what's the point of all of this? Well, Canada's dealing with inflation and the United States is dealing with inflation. That's the only point that I really want to make here. What about the tightness of labor? Well, against predictions that when COVID hit and this unemployment rate spiked and it was going to stay up there for a long time, as you can see, that's what happened in the wake of the global financial crisis. A massive spike in unemployment, which was massive back then. COVID makes it look like a walk in the park. It took an awfully long time to get that number back down again. Hello, what's happened here? Well, everybody got back to work really quickly in the United States. And now even the rate of labor force participation is approximating what it was before. So all of this hidden unemployment and the great resignation and everything that people were talking about back then, that's pretty much over. And they have an unemployment rate that is hitting historic lows. Now I put this little bar in here. What's NAIRU? NAIRU is the non-accelerating inflation rate of unemployment. So as long as you're not going below this band, then you're not going to get wage pressures that cost push inflation way up. Now, what's dangerous about inflation right now is it's not just specific commodities that are going up. It's not just supply chains being arrested that is causing inflation to go up, which are things that can be dealt with much more quickly. Now we've got a situation, they've got a situation where labor markets are extremely tight. And so there's bidding going on for the available labor that's there. They're not just talking about skilled labor anymore. They're talking about anybody with a pulse out there. And so this kind of tightness actually ends up dovetailing with an inflationary episode that should be temporary, and it threatens to make it permanent. Why? Because once that wage spiral starts to rise, that's an element of firm cost that's very, very big in terms of overall costs. And once that starts rising, it's very, very difficult to pull it down. So here's how the dynamic works. You get a specific price increase, prices start to go up. People say, okay, we've got to pay a little bit more for all of this. You get a tight labor market and people say, hey, we got to pay a lot more for stuff. So we need better wages and they start pushing the marketplace, and because of tightness, they get what they want. I'm hearing horrendous stories about, 20% pay packet increases for jumping across to a company for the exact same job, no increase in responsibility. And this is starting to occur. And, if it becomes generalized, we're in a lot of trouble because it's going to be very difficult to wrest those prices to the ground. And that's one of the key reasons that central banks are as aggressive as they are right now. Okay, on this score, you might think, okay, well, Canada's not in the same situation here. Surely we've got a little bit more bandwidth here. Well, anybody that owns a company knows it's very, very hard to get labor in Canada. In fact, our situation is more grave. We've got a lower unemployment rate now with full employment in terms of labor force participation. And we're now below where we were prior to the pandemic. And our non-accelerating inflation rate of unemployment band is higher than in the United States. So look, this dip below here has put us into the critical zone. Companies are redlining with respect to availability of labor, and it's worse than it was prior to the pandemic. Well, did anybody tell you that was going to happen? Absolutely not. The expectation from most learned people that are widely respected around the world was that we are not going to see anything like this kind of rebound in the economy. This is a V-shaped recovery if there ever was one. And one of the last things to actually settle is usually unemployment. And so the fact that unemployment has banged right back into a danger zone so quickly means that even this lagging indicator has responded very quickly to the uptake in global growth as a result of the pandemic actually being over. That leads us to the question, why? Why, against all of the predictions that were made of this being a long and drawn out affair, similar to the post-global financial crisis period of time, why did it rebound so quickly? Well, I believe our global context was misread. And this is something I've been saying for a long, long time. Prior to the global financial crisis, this was our doctrine, I guess, at Export Development Canada. Typically what happens in an economy is we've got an economic cycle. This is a typical sine wave. And so I just mathematically put a sine wave into here, and it's just so that I could get a curve that had all four elements of the business cycle. They're not to scale because, and I'll explain that in a sense, but we have the peak of the economy. We have the recession phase. We have the recovery phase where things turn around. And then we have the growth phase, either the four phases of the business cycle. Now, to put it into proper scale, recessions are not the dominant part of the business cycle. They typically will last, anywhere from 6 months to 18 months. 18 months is a really bad one. And 6 months is sort of that 2-quarter one where, it all depends how deep the drop is, but it's typically over a reasonably short period of time. The rest of it is growth. So recovery, growth, and peak are all the growth, grosso modo, they're all the growth phase of the cycle. And that's typically about, let's call it 8 years long. So if you got 2 years to go through a recession at the max, and you've got 8 years in the rest of the cycle, then an average cycle is 10 years long. And that's what we've been used to. We've been used to a 10-year cycle and all of these phases happening inside of a 10-year cycle. Well, what we have right now, thanks to the advent of communication technology, the exponential increase in technology writ large, and the opening up of globalization. Put those three things together, and it's actually taken a 10-year cycle and stretched it out into 20 years. Now, why it's really important to understand this is it changes our entire approach to the way that we look at the economy. What technology has actually done is to increase exponentially the amount of information we have available to us. And our brains have not expanded to keep up with that pace of knowledge change. And so Peter Hall's little theory of how this actually works is more information trying to cram itself into the same cranial space means that we have to take old information and it becomes more and more distant to us because we need to make room for the current stuff. Of course, read the news and talk to anybody who's strategizing, talk to anybody who's observing what it is that's going on. And the view is very short term at the moment. I'm very concerned about that because our lack of grip on history couldn't happen at a worse time if the economic cycle is being stretched out. Now, what does it mean that we would have a 20-year cycle? Well, what it actually means is we have longer longs So we have about a 16-year growth cycle. You know, if you double the length of the cycle, we have longer potentially and more devastating recessions. Why is that? Well, the bubble on the end of an extremely long growth cycle is also extremely long. And we witnessed that prior to the global financial crisis, a peak period of time where the bubble in the global economy, not just localized, but it was exported everywhere, lasted somewhere between 5 and 7 years. Well, that wasn't going to be a short recovery period of time, because once the recession is over, you've still got this massive overhang of a bubble to get rid of. And that's exactly what happened. We had a very long and drawn out recovery period of time with mediocre growth. Now, when we have less of an appreciation of history, what happens here in these exaggerated phases of the cycle is that after they've gone on for longer than normal, somebody comes along and says, well, this isn't what happened before. This must be a new normal. And when somebody says that, you know, something is a new normal, you got to be really suspicious at that point in time, because what they're saying to you is, we don't understand what's going on and we don't know how to describe it. It must be something completely new. Let's see how it works out. And so the forecasters put their pens down and they shut off their models and they say, we're just going to sit on the sidelines and observe what's going to happen until it's over. And if it's a very protracted business cycle, you're going to go through 4 phases of that business cycle over 20 years, not knowing what's going on. You see how tragic that is? You see how, you know, when people are actually saying, wow, you know, we can't do this thing anymore. I believe fundamentally the simple answer to all of that is what you see in front of yourself right now. It's a stretched out cycle. And when we understand that it is a stretched out cycle, then we know how to respond to it, business strategy wise, politically, in terms of policy development and appropriate responses to all of this and so forth. Now, I'm not saying that there aren't devastating consequences of the way this kind of cycle actually manifests itself. And we could go into details of that. And if you want a good illustration of that, ask me in Q&A and I'll say, it's not easy to have a cycle like this. But if we leverage a cycle like this and we have these extraordinarily long growth periods of time, there's a tremendous amount of prosperity that that we can latch onto there. And of course, in the last cycle, we had a very, very prosperous cycle. But everybody got, you know, sort of inured to the fact that that's the way the world works. And then when it unraveled, it was like, well, this is unjust. We haven't seen this for 16 years. Some people had no experience of a recession when the global financial crisis happened. And so, of course, it being as devastating as it was coupled together with the lack of experience of recessions, and people just completely lost it and looked to government to actually bail everything out. And now we're in this new sort of world of expecting the government to do everything for us when the economy actually goes down. Okay, I could wax on about this, and that's maybe going to be the topic of a forthcoming book or something like that. And, you know, we can deal with the details there. How do we take the presentation further then? Well, the question then is, if, as I've illustrated before, the US and Canadian economies are so in sync with each other, has this economic cycle, this protracted economic cycle, made any difference? I think I've gone through all of these reasons. Why that's stretched, technology, communication, logistics, labor constraints. Oh, labor constraints, I didn't mention that one. So why did we globalize? Well, we were running out of labor in the West, and there are a lot of emerging markets with lots of spare labor, China being perhaps the greatest example of that, but India waiting in the wings in the same way. And of course, Southeast Asia and Africa and so forth, lots of spare labor in these places. And that's what drove a lot of business into those locales. You know, North American, European companies were investing in the Far East because they actually, you know, could leverage the labor that was there. And so, you know, tons of investment actually made its way over there. Of course, the emerging markets themselves were ready for this when it happened. You know, China had turned the page on its old system and looked at more of a market-based / managed system and so forth. So all of these reasons are why the stretch actually occurred. There's lots of reasons to believe that this is actually there. Okay, I'm going to get back to that chart here. What about these two economies? So we've looked at the similarities. What about the differences here? This is where I go to the housing market in the U.S. Now, everybody's interested in the housing market because I think we all live in houses, whether we rent them or own them, and you know it's something that's near and dear to our hearts. You may not be interested, though, in what the housing market has to say about your own business. Well, whether you're in housing or not, you should be interested in this because housing is one of the greatest leading indicators of overall economic activity that exists. It's been very dependable for me as we've gone forward. And so as you see, what is happening inside of the housing market, it's very, very important to understand how it affects all kinds of different businesses, not just in the own economy, but when we're talking about the US, how it affects the world economy. Now, I know what everybody's saying, okay, the last 2 points on this chart don't make me very comfortable about where the economy is going. Let's ignore that because that's not the point of this chart. And I believe that, housing is volatile. Don't get too excited about a couple of downs there. They're dramatic downs, but they're still above this orange line here. Let's talk about the orange line. That's generally accepted demographic requirements in the US economy for housing. So when you take births, deaths, the existing population and how it's aging over time, when you take immigration and emigration, put all of that together, crunch it through a demographic model, figure out what household growth actually is. In the United States, it's about 1.4 million households, new households per year. And that's effectively how many houses you need to create. Well, you can see that the housing market doesn't behave itself because, back in the early 2000s, we had an incredible amount of overage. And so the dark purple line is the amount of building that was going on. And the light purple bars in the background there is the enormous amount of overcreation of stock that was actually occurring. And because of this overage, when the bubble actually burst, look at how that line went down. It dropped 75%. That's all building in the United States. So that's the residential building industry, whether you're talking about condos or singles and doubles or multiple units of whatever kind. There was too much in the marketplace. And so it plunged 75%. The whole industry experienced a 75% drop that was around for 2.5 years before the market started a very, very slow climb back out of the pit. Well, that's what enabled this enormous overage of housing stock to get sopped up. But the market stayed too low for too long. They got excessively pessimistic. And now you can see that those purple bars are well below the line. And there's more than a year's supply of pent-up demand there. Well, this is not a bubble economy that's ready for a recession. This is an economy that's ready to take off. And indeed, it was just starting to do so before the pandemic. The pandemic hits, you get a wiggle there, and then the recovery continues. And people say, well, why is that? Is it because of low interest rates? Is it because of artificial stimulus in the economy, too much liquidity around? Certainly that's affecting things. But I believe that that's the reboot. That's the defibrillator shock to the system that the US has needed to actually have a proper recovery in this key leading indicator of the US economy. So it's why I have said all over the place, hey, the US is an economy where there's incredible pent-up demand. It's not ready for a recession. And that's why we had a V-shaped recovery coming out of COVID, because the basically policy shut the economy down. And it's not going to be a protracted recession unless there's a bubble ahead of all of that. Then it's going to be a protracted recession. But if there's no bubble, and if there's pent-up demand, which is actually an anti-bubble, you're going to recover very quickly. So we said that was what was going to happen in this case. So we look at this and say, wow, this is incredible. Okay, what's more incredible is you could drive US housing starts back up to the 1.8 million unit level and leave it there for a number of years. And it would take you, I think, 3.5 years to actually clear the deficit in US housing that is actually there. So I played around with a number of things. You could drive it up to 2 million units, which would be extraordinary. And you could sustain that for quite some time. It wouldn't create a bubble in the US economy until, 2.5, 3 years out there. Well, that's got to be good news to anybody who's worried about where the world economy is actually going to go. Because the wiggles that we are seeing in the economy right now, the adjustment to interest rates, the discombobulation of supply chains and so forth, can cause the US economy to falter for over a very short period of time. But fundamentally, it's not in a position to actually sustain that going forward. It can jump out of that very, very quickly. So if there is going to be a true US recession, it's going to be a very short one as far as I'm concerned. And I believe that we are actually going to see the US economy grow quite handily out of that in a very, very quick period of time. Here's where the contrasts are greatest between the Canadian and US economies. This is where an appreciation of history is really important. While the US economy was creating a great big bubble, the Canadian economy was dealing with a massive housing deficit. Why was that? We went into the 1990s and we had a very long jobless recovery because our debt situation at the federal and provincial levels was so overdone compared to the rest of the OECD that we spent at least a decade in very, very strict and stringent fiscal tightening. And so young people in the Canadian economy were not very happy at that time. It took a long time, it took multiple years for the economy to start getting back on its feet again. And of course, like the rest of the world, we started overbuilding houses, but we, in contrast to other economies, were not creating a housing bubble. We were actually getting rid of a housing deficit. And that's why when the global financial crisis occurred, you see this line going down here in about the middle of the chart. You see that big down there. That big down was a lot less than the big down in the United States, by the way. And our recovery was almost instant. You see how quickly it comes back up. And our orange line there is 185,000 starts. I believe that is Canadian demographic requirements. And at one point in time, the Bank of Canada used to agree with me on that. Well, since then, because we were so proud of how strong our economy was and how robust our recovery was at that point in time, in contrast to what was going on south of the border, we started building like crazy. And now on the end of this chart, you can see that we have an egregious overage of housing inside of Canada. So in contrast to the United States, which can rise from its level of housing starts now, if Canada goes down to a paltry rate of 130,000 housing starts, it's going to take until mid-2027 to actually clear the surplus that we have, if I'm correct in the calculations that I'm actually making. Well, could you imagine, a different set of circumstances in the Canadian and US economies? You might say, well, no, I can't. Well, then you've forgotten what I just told you about what happened in the global financial crisis. The US economy went down and stayed down for a long time, and Canada didn't. So that was the first test case of the fact that the US and Canadian economies are doing something a bit different here. Now, what I believe is happening is we've changed positions. The US economy is going to be that economy that, if it goes down, isn't going to spend very long down there. But if Canada goes down, the housing market is telling us that we're going to be down, at least in terms of the domestic economy, for quite some time. So that's what we need to get ready for. You might say, okay, well, thanks a lot. That's the worst news I could possibly have hoped to hear from you, Peter. What's the hope inside of the Canadian economy? Well, the good news is that if the rest of the world is strong, and everything that I've said for the US economy is basically true for the housing market and for pent-up demand in the European economies, then we've got about 50% at least of world GDP that is in pent-up demand mode. Now, those are economies that actually drive emerging markets as well. So you can layer in a whole lot more GDP that's going to be doing a whole lot better than Canada is going forward. Okay, so what's the hope for us? Well, the hope for us is don't put all your eggs, or very many of your eggs, into the domestic economy basket. Shift them into the export market, because if you are an exporter, or if you can export, or if you can sell to those who are, then you're actually going to ride the part of the Canadian economy that is actually going to do a whole lot better inside of all of this. So that's a key message coming out of all of this. Now, all I'm saying there is that when it comes to the economic cycle, it seems to me that the US, and for that matter, Western Europe, are still at the end of the recovery phase with a whole lot of growth ahead of them. And Canada is actually up closer to the peak and doesn't have a whole lot of runway left in its own cycle. I hope that makes some sense to you, and I hope it doesn't offend you in terms of how you've looked at the economy. And it's meant to challenge you to say, this is really how we are seeing things. I'm quickly running out of time, and I do want to leave some time for Q&A. We're all obsessed by inflation right now, and I just want to leave you off with an inflation primer. It's been 35 plus years since we've had the kind of inflation that we have right now, and I think it's important to actually go back to the lessons that we learned in the 1970s about the way that inflation and inflation psychology works, so that we can understand a little bit better what's going on right now. The big question is, why do we have inflation right now? I think reason number one is that we were not expecting it. And we were not expecting it, not because we had 35 years of, very tame inflation. Actually, that's one of the big drivers of it. But we were told by some very key influential international people that it really wasn't going to occur. Okay, so let's just, analyze that. One of the most influential books when COVID first set in, and I say it was most influential because world leaders of every stripe were quoting from Klaus Schwab and Thierry Mederer's book, the, what is the title of that book? That's what happens to you when you get older. The Great Reset. That's just, a brain lapse there for a second. The Great Reset. Remember, everybody's talking about the Great Reset. This is a great opportunity. Don't waste a good crisis. What was one of the premises of that book on the Great Reset? Well, one of the premises was that the economy was going to be so awful for a long period of time that it's basically the failure of capitalism. And so we have to reconstruct all of our institutions and we have to craft a new system. Well, what are some of the key quotes inside of that book? It's hard to imagine how inflation could pick up anytime soon. Well, it beat the land speed record for breaking a 35-year regime. So this couldn't have been more wrong. The unemployment situation is bound to deteriorate further. Remember, this was June of 2020 when that big spike happened. It's bound to deteriorate further. It cannot improve significantly. And that was almost instantly wrong in terms of being a prediction. It will constrain, okay, so the unemployment situation will constrain wages for years. No need for big rises in wages. And right now we see unemployment rates that are testing the lower limits and wages that are spiraling out of control in the Canadian economy and the US economy and European economies because of our paucity of labor right now. So wrong, 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 and more wrong. Strong consumer demand is unlikely. Well, a chart that I flipped over there, and I'm not going to go back to it because it's going to take too much time to go back to it and then to come back here. But when you actually get a copy of this, go back to the chart that talks about demand deposits and the US economy. There's a flat line there. This is usually very, very boring series. Nobody puts very much money into demand deposits. They invest that money either in the financial market or they plow it back into their businesses or they upgrade their homes or whatever. Why have demand deposits soared as much as they have right now? Well, COVID shut things down and people largely kept their jobs. And so what happened was the paycheck was coming in, you weren't going on big tourist ventures around the world. You were not going to concerts. You were not going to sports games. You were not going to restaurant meals. And all of these things and more besides add up to a lot of your monthly or annual budget. And so when this money wasn't being spent, people just threw it into the bank account or they didn't even think about it. Their pay automatically goes in and they just weren't spending as much. So unbeknownst to them, their bank account has swelled. They take a look at it every now and again. Whoa, the eyes pop. Because that number actually in the United States economy adds up to 20% of GDP. You might say, okay, well, 20% of GDP, so what? So what? I get excited about revising US GDP up by 1% in any given year. If all that money comes into the US economy all at once, do you know what I have to revise the US economy up by? You guessed it, 20%. That's an amount that's compared to GDP, folks. And if it all goes into the economy right now, you think we got a problem with supply chains now. We've got all this pent up demand that isn't the pre-existing pent up demand I was talking about before the pandemic actually occurred. This is pent up demand that built up during the pandemic. And most people are not ready for this when it hits the economy. Now, Canada has its own version of this, which will keep us from falling into recession immediately. It's going to delay it. And people may say, oh, we got through that. That money's going to get exhausted and whammo, we're going to really feel it. The United States economy can go on for probably 5 years with this money continuing to fuel growth over that period of time. And that's pretty powerful, not just for the US economy, but for the Canadian economy and for that matter, for the rest of the world. So there's a lot of pent up pressure that makes this wrong here. So strong consumer demand being unlikely couldn't be further from the truth, folks. And I don't want to dump unnecessarily on the founder of the World Economic Forum, but when you're predicating a change to the world architecture that's very experimental on things that didn't occur, sort of wonder, okay, what should we do with those predictions then, which some are actually implementing at the moment. I don't want to get tied up into that debate because, fine, let's bring some good things out of all of this, and that's fine. I think, with everybody. But when you're talking about a complete re-architecting of the system, whoa, let's not move too quickly here. That's just reason number one. Number two, pre-pandemic pent-up demand. I've already talked about that. So, when we rushed back as an economy, people weren't ready for it and caught us off guard, and supply chains couldn't get up and running right away. That's why we have inflation right now. That's not a permanent thing, I don't think, because we had enough capacity ahead of the pandemic. It's just a matter of getting that capacity running efficiently again. Okay, and then there's mid-pandemic pent-up demand. We already went over that. Supply chain disruptions. Why are they occurring principally? Well, COVID did not hit every economy at exactly the same time, and we're still working our way through this. You get an outbreak somewhere, they have a partial or a full shutdown, as in China's case, and it's highly disruptive to supply chains. It doesn't mean supply chains are broken. It doesn't mean the logistical system is not working. It means there are certain economies that aren't open. And so that part of the supply chain, and we're still pretty vulnerable to geographic supply chains at the moment. That is just going to take some time to work out. We're still working through the throes of that. It doesn't mean we don't have enough capacity. It just means that we have a temporary problem with our supply chains that will sort itself out. But there is a bigger problem as well, and that is insufficient investment. Because of the length of time it took us to recover from the global financial crisis, that lulled businesses into the sense that they didn't need to invest as much. And I think that is patently false. I think there was a period of time where we didn't need to invest like we did in the past. It's not a new normal. It's a temporary situation that lasted multiple years. Why? Because we had a great bubble of excess investment at the end of the last cycle to actually use up. Once our capacity utilization rates get up there, okay, now it's time to invest. Forget about this conservatism. We need to open our wallets, and we need to increase the amount of machinery equipment we have out there. And we certainly need to increase our plant space as well to keep abreast of demand. And so there is a sense in which we haven't done that. We're getting caught short right now. So 5 reasons why inflation. Quickly on the psychology of inflation, it starts off, you have particular shortages. And so what does that lead to? Specific price increases. Nobody gets too excited about that because everybody can say, okay, if it's just those prices, okay, let's deal with that situation. Let's get supply back up there, and inflation goes away. And that's what we've done for the last 35 years. But if you have then a supply chain problem layered onto a fast recovery, that can actually be a whole lot more dangerous because it becomes more generalized across a much wider range of goods and services. When that starts to set in, it's the beginning of a problem. If you do not message that properly, then people get into thinking, okay, this is just the way the world is now, instant change. We've got to adapt to this change. We've got to buy as much as we possibly can because prices are only going up, and it just sort of feeds on itself. And at this phase here, that's when central banks were saying, okay, we have got to message heavily out there. Hey, this is just a temporary phenomenon. We've got this one, and so forth. And every central bank was singing out of that songbook. The difficulty is people got to the point where they said, you know what, it's just feeling like there's no more 2%. There's not a lot of credibility to that. That's when you get a change in general expectations. That's very, very hard to reverse. Now, what does that look like regularly? Well, I want to put this addition on the back of the house. Now I've got to pay, 2.5 times for a 2x4. Well, I want to get this project done, and I've got the money, so I'm just going to do it. And so, everybody is willing to, shell out in this kind of way. And what do you do about a situation like that? Well, everybody realizes, okay, it's going to cost more. And I can't do this forever, but I can at least do it for now. And then it does become more generalized. Now, the worry inside of this is you may not have a supply chain problem. You as a business may have all kinds of supply, but you see that everybody's able to pass on like 15% price increases, and you can't resist being opportunistic about this and saying, well, I don't have a supply chain problem, but, I might in the future, I don't know. And then you get this opportunism, and then it becomes a self-fulfilling prophecy. Because as every good and service goes up by 15%, every good and service in the chain needs to go up by 15%. And you get a locked in mindset that then feeds itself into specific prices. And of course, every price becomes a specific price, and it feeds right through the system. And that's, folks, why we have to have aggressive central bank interest rate increases. That's why we have to have quantitative tightening that's quite aggressive as well, not just in Canada, not just in the United States, but with the ECB and certain emerging markets as well. Okay, I'm really running out of time here, and I should probably just call it off there. There are a couple of other things that I wanted to share with everybody, Eric. Let's just get back to our conclusions here. So basically, we've got a stretched out cycle. The US and Canada, I believe, are at different points, and that really makes a big difference for us here. The sources of growth are changing. So for Canada, we're having a growth shift from the domestic economy to the export economy, but within economies that we export to. It's not just the US, it's not just Western Europe. In fact, the most exciting markets are the emerging markets of the world. And that's where I believe as growth goes there, Canada needs to be thinking about doing way more business there. We do very little business in emerging markets right now, but it's growing. The transformation is occurring. So keep that in mind as well. Investment is badly needed. I believe that especially on the export side and the side of the Canadian economy that's feeding exports, we need to invest because we simply do not have enough capacity. There's a couple other things I could say there, but growth is an elixir. You know, we have this fundamentally weak domestic economy, but if there are sources of growth, then they help the domestic economy to get along. The domestic economy becomes far more dependent on the export sector, which is not a bad thing for Canada. And we're able to pull ourselves along as a result of that. The downside is not as devastating because the export sector pulls us out. Now that is if we latch onto it. If we don't, then you know we're in an awful lot of trouble. Well, this guy is telling all businesses I can get my hands on that they need to focus on this export side of things because it really is the growth and hope story for the future. Okay, so let's just go then into our Q&A period of time. I've left us a kingly 6 minutes for that, and I apologize for that, folks. I really upped the ante, I think, on some of the aspects of this presentation, as Eric will know because he heard the former one. So Eric, over to you. Let's see if we can deal with a couple of questions before we're done.
Sure, let's do it. So I invite everybody, please submit your questions now. The first thing I'll say is, you know, I think there was so much content in there. I'm so intrigued. I feel like we could have like a 2 or 3 hour conversation, and I'm sure you've done those before. So I mean, to summarize, I feel like there's a lot with the, I guess, emerging markets that we should be focusing on as business owners. You know, I think it's Canada that we need to protect ourselves, the domestic kind of market. The housing seems to be oversupplied, which has an impact on a lot of our businesses indirectly, in some cases more directly. And so there's a little bit of an opportunity to shelter our Canadian risks by either getting US clients if we can, or with companies that export to the US or other countries, right? And so I'm thankful that we'll get a copy of that PowerPoint, just because we're gonna be able to go through some of the finer details that you weren't able to get through as much. So yeah, this is huge. I think, I don't know if Mia or Madison, if you see any kind of questions coming up, I have one here that I could mention. You've touched on some real estate side, like on the housing. You didn't discuss too much on the multifamily investment properties. So, you know, there's kind of like capitalization rates that tie into interest rates, right? And so if inflation is going up, do you see capitalization rates also going up, which essentially will bring down the price of multifamily investment properties? Does that kind of make sense? Like, or yeah.
It does. I would appeal to a more dramatic dynamic, I think. And it has to do with the fact that when a market is on the way up, and when you see annual increases in anything, in this case, it's real estate, that is way outperforming the rest of the marketplace, you cannot stop the speculative element. You can put all kinds of laws in place to try and attenuate that activity, but it will find a way of occurring. And so one of the things that I observed that has been going on actually for numbers of years is that real estate agents have said, hey, you know, there is this capacity pressure inside of the marketplace that makes the rental market a real winner here in Canada. So you're moving from one town to the next, and you're coming in to this town and you're buying a place to live. You should be buying 4 places. You buy the place that you're going to live in, okay, and you put the bulk of your equity into that, but you can get into highly leveraged loans, and the rent that you can charge on this will more than pay for your mortgage at these very reduced interest rates. Okay, so there's some assumptions that are being made. The world isn't going to change. The tightness is going to be there. The interest rates are going to remain low. Prices, are going to be roughly stable or rising over this period of time. So if everybody that was buying a house in the last 2, 3, 4, 5 years was buying 4 houses and creating this kind of pressure in the economy, it's pushing prices up to the point that certain, vast swaths of the economy simply cannot afford to buy, and they must rent. And so it's boosted the rental market out there. And so it's created a situation that looks like it's sustainable. I'm sure that there are many that are out there that are saying, hey, the equity gain that I'm getting in my house is good enough that I don't even have to have a renter out there, because I know that I can sell this in 6 months or a year and make a killing, and I can keep flipping houses. And there has been that activity going on, and the federal government has sought to put laws into place, to tax those houses. You can't do a principal dwelling flip inside of a year and hope to make a gain on that, because if you do it inside of a year, you're going to be taxed on that first time ever. And so, there is that speculative activity that's happening, and different provinces and the federal government have tried to come up with laws to keep that from occurring. You just can't. You can never keep it from occurring, especially when you see annualized gains of like 20% plus. You just can't keep people away from that. And a lot of people have done very well by that, but it does mean that the market's overdone, and it is setting us up for a big correction, as it has in the past. Same kind of phenomenon has been observed. We're no different than we used to be. We want to capitalize on these things, but when the bubble burst, it burst pretty badly. And so it did in the United States in 2008, and I believe that we have set ourselves up already for the same thing in Canada.
Okay. And I guess another topic, I don't think you touched too much on currency, on the Canadian currency, US currency, and other foreign currencies. Is there some sort of strategy or something that we should look at on, inflation and how they may impact each currency? Is it, because it's not necessarily easy for all of our businesses to just start doing business with people in other countries, but we may have exposure in, let's say, US dollars or the euro. And so would you advise that we, step outside of the Canadian dollar a little bit more to kind of like shelter ourselves against the inflation? Or what are your thoughts on that?
Sure. When we're looking, Eric, and for everybody's edification here at the Canadian currency, it still is a commodity currency. There are a few other things that are moving it around right now, and we also benefit from the fact that we're joined at the hip to the American economy, and the greenback is riding high. I'm one that's sort of surprised that our fluctuations haven't been more dramatic in the Canadian currency, because oil is something that really influences our market a lot. When international prices go up, well, for every $10 increase in West Texas Intermediate crude, and there have been a few of those in the last little while, our currency is supposed to rise 3 cents, and that hasn't occurred. That has to do with the fact that we've got a carbon reduction program going on inside of our economy that has caused investment in the oil patch to go down, and has actually compromised shipments of crude oil and natural gas. There have been other things as well, the truncation and the cessation of the Keystone pipeline, and so we've had limited ability to actually export actual products. So a bit of a break in the traditional link on energy prices. Other commodity prices are highly influential as well. So the non-energy set at the moment, I would have expected the Canadian dollar to move more on things like food prices and base metal prices, and it hasn't. And so if we're expecting that some of these prices are going to come down, I would typically be forecasting a downdraft in the Canadian currency going forward. I do expect that to occur because of the weakness of the domestic economy and the eventual drop in commodity prices. But I don't expect that to be instant. We're looking a couple of years out, and maybe a Canadian dollar that is plumbing the lower 70-cent US range by that point in time. But for the time being, it's been remarkably resilient. And I certainly expect that because of the temporary strength that even our domestic economy could show over the next few months, that it's going to be a hold the line kind of currency movement. That's the best that I can do. I actually developed a currency model for export development Canada when I was there. It had 5 drivers inside of it, and I've generally talked about most of those. I didn't talk about differential interest rates because, our monetary policy seems to be pretty much in lockstep with that of the U.S., and that neutralizes the impact on the currency.
Okay.
So I hope that's helpful.
Yeah, no, that's good. And then maybe one last question here, if we have the time. On the housing side of things, your analysis and predictions are based on a national kind of perspective, right?
Yes.
And housing can be so local, right? And so I guess part of your analysis does it have a blind spot towards oversupply and undersupply in local areas? And so maybe as a whole, there's an oversupply, but Toronto might have a huge undersupply, or vice versa. So yeah, maybe kind of walk us through kind of, I guess, the specifics like for regions for that.
Well, I'm less of a regionalist when it comes to the housing market, and especially a housing market that has been this strong for this long. And here's why. When you're sitting in Vancouver and you paid $500,000 for a particular dwelling at a point in time, and now that's worth $1.5 million or $2 million. And let's say you come from Prince Albert, Saskatchewan, all your family is there, and you're working in Vancouver because you have to. And what's not nice about working in Vancouver, but the parents are aging, and the family that's back there is having a great time. Maybe there's some obligations there. You could sell your 1.5 million to 2 million home in Vancouver and live in a king's mansion in Prince Albert. And so you sort of think, okay, I could have the house of my dreams there and look really good to everybody in the community. Hey, here's the guy who left and came back and did really well.
Oh, I think did we lose your audio here for a sec, maybe?
Well, I was just into the thick of this wonderful story, so I hope not. Am I back?
I can hear everything.
Oh, I think maybe it's just my connection here.
Okay. Anyway, what happens is you get an exporting of that price pressure right across the country as a result of that, because people have grabbed their winnings and they've gone back to home, and COVID has just increased that activity as well. And so I believe that because of the length of time that this has gone on, there's really no market that has been able to escape the effects of all of this. And the dramatic nature of it all has meant that, unfortunately, as the market goes down, generally speaking, everybody's going to be affected.
Okay, well, this is huge. This is super insightful, Peter. Thank you so much for the time you took today to talk to us. I will look forward to that PowerPoint so that I could share it with everyone afterwards. As I mentioned, this is going to be recorded, so we're going to send it out and make it available to everyone. Is there a way for people to reach out to you afterwards? Is that in your PowerPoint if they did want to talk to you afterwards about their own specific business or things like that?
Sure, there are 3 ways for that, Brian. There's my email address, which is simply phall@econosphere.com. But you can reach out to me via Twitter or LinkedIn, and those addresses are actually on the PowerPoint itself. So I'll make sure that my email address is on the copy that I sent across as well.
Awesome. Okay, well, thanks again, Peter, and have a good rest of the day.
Okay, you too, Eric, and thanks everybody for joining us today. Cheers.
Awesome.